Hey kids, welcome to your next unit. I hope your first assessment went well for you, and it's time to turn the page and add to what we've learned in our first unit in the class. So I'm not going to typically do this, but today I'm going to walk you through um, this new note. I know you can read and I know you can review notes, but this concept now is going to be really important. So the transaction analysis sheet that we introduced in the first unit is very cumbersome. It allows us to see what's going on with accounts, but it really is not user friendly. It takes forever to do, so we're going to scrap that. That's there just very quickly. Even when I teach in person, I use it for literally 3 or 4 days, and then it disappears for the rest of the semester. And I want to get into something called T accounts, and we will use this throughout the course. This is a type of something called a ledger, and we'll be talking about a ledger later on in the course as well. But I do want to talk to you about T accounts today, and then I want to show you a few transactions. We're also going to get into a very critical part definition in accounting, and that is debits and credits. So let's get into that. I'm going to see if I can blow my slideshow up and it won't disappear. Let's see what happens. Nope, that doesn't work. Okay, so let's do it this way. So the second and third bullet point is really what I want to talk about here. Debit in accounting simply means left side of an account, and I will show you what that means shortly. Credit means right side. So don't think debit means something's going up or down or we're paying with a card that comes out of our bank account. Don't think credit refers to a credit card or that things are going down. It just is a different word. So debit means left, credit means right. I need you to memorize that. So debit means left, credit means right. So when we're doing transactions, if we're going to debit something, it simply means we're going to write the number on the left side of the account. If we're going to credit it, we're going to do it on the right side of the account. And there are rules that we need to follow. You are not going to get these rules off the bat. Give yourself some grace and a few days to get used to doing these. I will also be doing an example today so that you can see it. All right, so I'm going to go back to the first slide. So this is what a T account looks like. Maybe I'll drag my face over somewhere else. This is what a T account looks like. It's called a T account because it's the letter T. You can see in kind of blue there that there's a uppercase T. On the left side is our debit, and on the right side is our credit. And so that is all you need to know at this point. Now here are some rules you need to know. We have 3 major transactions that we are using in this course right now, or account types. I'm sorry, there's someone knocking on the door and they're driving me nuts here. Those of you that go to my school, you guys are knocking on our door constantly looking for Chromebooks, you evil Chromebook users. Okay, so back to what I was going to say. So we have assets, liabilities, and owner's equity are the 3 major categories of accounts right now that appear on our balance sheet. Here are the rules. On the balance sheet accounts, if they are an asset account, so cash, supplies, accounts receivable, land, building, equipment, etc., they increase with a debit. That means they go up on this side. So if it's our cash account and a customer pays us, it's going to go on this side, the debit side. If it's a cash account and we are paying money, it's going to go on the credit side because our cash account is going to go down. For liabilities and for our capital, so if we have a mortgage, for example, when we take on a mortgage or we get more mortgage, it's going to go on the credit side. So liabilities increase on the credit side, decrease on the debit side. Same with our capital. So if the owner invests money in the business, we get cash, which is an asset. It's going to increase on a debit. We also know that our capital is going to increase. The capital account, which will be a separate entry, will increase on our credit. So let's take a peek at how that works. All right, so in this case here, the owner invested $10,000 in the business. When you did your transaction analysis sheet, you probably said plus 10,000 to cash, plus 10,000 to capital. In a T account, this is what it's going to look like. Cash will be debited, so the left side of the account will be $10,000. We don't use pluses or minuses. And then capital will be credited on the right side, $10,000 as well. So same thing you did on your transaction analysis sheets. We are just posting it a little bit differently. So in this case, the owner invested money in the business, cash went up, and capital went up as well. The next transaction, we are going to see that we purchased supplies. Hello, yes, I'm shooting a video right now. That's why I didn't answer the door. I don't. Okay. All right, so I'm going to keep on going with my video because, as I said before, I'm human, and I want you to know that human things happen. So a student was very impatient and opened the door. And even though I said I was shooting a video, decided to try to have a conversation with me. It's these real-time things that make this class so wonderful, isn't it, kids? Hopefully I didn't sound too cross there to that poor student. Okay, so the second transaction here is we purchased $100 worth of office supplies. You'll see we don't wipe out the $10,000 we had in the previous transaction where the owner invested money in the business, but we have our supplies being debited because they're going up by $100, and our cash is going to be credited because it's going down by $100. We can see a left side, right side transaction here. Left side or debit is supplies. Right side, the $100 is cash. So there's our debit, there's our credit, and we're good to go. On we go. Now, the balance in our account now for cash, we've had two transactions. 10,000 minus 100. Our balance is $9,900. We show our balance by listing it on the side in which it should appear. So cash should have a debit balance. So that $9,900 is where the cash balance is right now. All right, so that is your note. I'm sure it's clear as mud. I'm going to show you an example now where we actually look at transactions. So what I've done here is I've actually preloaded, I'll blow this up a little more for you. I'm sure I could win awards for the quality of these videos. I'm sure you love them. All right, so these are the opening balances. I've moved ahead a bit. Let's say we had a balance sheet, and that balance sheet showed cash 120, accounts receivable 12, and so on. What I've done is I've just preloaded the existing balances into the accounts. So in this case, we've got 6 asset accounts. They all have their opening balances on the debit side. Debit meaning left side. We also have liability accounts. They have credit balances, which means their balance just shows up on the right side because that is where we put our liabilities. And the owner already has $115,000 in the account as well. So let's do some transactions. Owner invested $20,000 in the business. We know cash is going to go up. We know capital is going to go up. So cash goes up with a debit, 20,000. And then I'm going to go to capital. And capital also goes up. Capital increases with a credit, 20,000. All right. And to simplify things, maybe what I will do here, so can we get all of these? I am going to color code these for you. Accountants don't typically color code, but let's do this. So 20, 20. All right, so the really nice thing about this transaction, and when we use T accounts, is we can see that we are going to be in balance always as long as we do a left side and a right side, or a debit and a credit. It'll always balance out. It has to 100% of the time. Now, someone might make a mistake. Maybe someone accidentally puts the $20,000 here, but visually they can see that's not right because I've got a debit here. And if I have a debit here, I'm going to be out of balance by $40,000 or twice 20,000. So I'm going to take that away so we don't confuse anyone. Okay, paid $600 on a bank loan. Let's do this one in green off the bat. So if I paid something, then my cash is going to go down. And then if I do this right, I should debit my bank loan by 600. All right. And so I owe less bank loan and I have less cash. Okay, next transaction, a customer paid their bill off. So when a customer pays us, we get more cash. And then we also have less receivables. So the customer doesn't owe us that anymore. All right, so we got more cash. We increase with a debit. We have fewer bills owed to us from our customers. So there we are right there. We bought office supplies and we paid cash. So this one looks like an orange transaction to me. Okay, so if we got supplies, we have $450 more in supplies. We paid $450 from our cash. So my supplies went up with a debit. My cash went down with a credit in this case. Okay. No, boy, I'm returning some stuff. Oh my gosh, did I really? Okay. Okay, so I returned defective supplies. Shouldn't surprise me, I actually wrote this out, so there's really nothing surprising here. So I returned $50 in defective supplies. So I have $50 fewer in the value of my supplies, and because I got a refund, that goes back into my cash. Okay, so I have more cash, so I debit it. I have fewer supplies, so I credit it. Debit means left side, credit means right side. Okay, I borrowed $10,000 from the bank. So I took out a new bank loan. This looks like a nice purple transaction. So I have more cash, so I'm going to debit cash. And then if that's all I did, then I'm in trouble because I'm going to be out of balance by $10,000. Liabilities go up with a credit or on the right side. So I want to see, I have a bank loan here. I'm taking out more bank loan. So there we go. And then finally I bought new equipment. Ooh, getting tricky here. And I paid some cash, but I'm going to pay some more later. So this is going to be a 3-entry account that we'll see for the first time. And I think for a 3-entry, we have to go with this wonderful shade of red. So I bought new equipment worth $51,000. So let me go to my equipment. I have $51,000 more in equipment. Equipment is an asset, therefore it increases on the left side or on the debit side. Now it says here I paid $39,000 in cash, so my cash is going to go down. But that's not it, because 51 does not equal 39. So 12,000 I'm going to pay later. When we owe our suppliers stuff, it goes to our accounts payable, and that is $12,000 because it's going up as a liability. So here's this transaction in the color of red. I think it was this one. Ish. Yeah, we'll go with that. Okay, so watch how this one equals out. I debited $50,000 in equipment. That's awesome. I credited 39 plus 12, which equals 51. 39 in cash, 12 in accounts payable. My cash went down, but my payables went up. So in summary, assets increase with a debit on the left-hand side. They decrease with a credit or the right-hand side. Liabilities and owner's equity increase with a credit on the right-hand side and decrease with a debit on the right-hand side. Final thing I'm going to do is I'm going to do these balances. So I'm going to add these up, subtract these. I'll show you a really simple way to do this. If you go equals bracket equals sum bracket, and then I'm just going to add up everything on this side. I'm going to close the bracket. Then I'm going to subtract the sum of this side here. I'm going to drag it all the way down here, even the empty cells, in case I end up doing a much larger project. Close the bracket. Okay, so I have $110,000 left in this account. I can actually just copy this over. If I did it right, this should show 11,600. Excellent. This should show 3,400. Excellent. Nothing happened here. Nothing happened here. So by doing this formula, it's basically saying, I'll take away whatever's here. I'll add all this together, take this away. Excellent. Now, for this one, my formula is going to be a little bit different. So I'm going to go. I'm going to add up this side. And then I'm going to subtract the sum of this side. And it makes sense because there was nothing going on there, that it's 37. This one we should see 85,000 minus 6 is 84,400. There will be nothing here. And this one should be 135. The last thing I'll do is I think I'll just add some double underlines. This is not an official financial statement. So all the dollar signs and underlines that we talked about in the first unit aren't as necessary here. But I like to do this because then it lets me know. So I'm going to put maybe a line at the top. It's going to let me know that I'm going to do a subtotal. And then I'm going to put a double underline. I have to drag my face away here. All right. And there we go. So that is how to do T accounts and debit and credit rules. This is a lot to take in, I know that, so give yourself a few days, work through some of the exercises that we have, and reach out with any questions that we have as well. This is a critical component of this course. Just like understanding a balance sheet, it's important that we understand transactions and how the debit and credit theory works, because we will be using this right through to January. Okay, take care, reach out with any questions.